Welcome to Credit Matters, the podcast where credit absolutely matters. I'm your host, Shankar Ramakrishnan, head of US Credit and Global Market Engagement at Informa. So Credit Matters, it's a weekly podcast series, the first ever to discuss global credit asset classes like the structured finance markets, the investment grade and high yield bond markets, and rates, FX, and macroeconomy. Markets which are complicated and almost hidden in plain sight, but attract billions of dollars of investments every year. We are kicking off the series with the largest corporate bond markets in the world, the US investment grade bond markets, which are on fire right now. After a record-setting January and February, March is expected to be massive too, with bank syndicates or the investment bankers who structure and sell bonds every day, expecting $230 billion of new bond supply. So what's driving this market to operate at such a breakneck speed? And did the Iran conflict have a lasting impact on this market? How are credit investors and issuers reacting to market volatility created by the Iran conflict? The impact on interest rates, inflation, well, there's a whole lot of these which is going to be answered, or some of it will be answered in this podcast. So let me start from the beginning. Why are we starting with the investment grade bond markets in the US, you ask? The stability of the global economy depends on access to long-term funding for the world's largest companies. And these corporate bond markets are the backbone of that funding. During the COVID crisis, the Fed took extraordinary liquidity support measures to ensure the biggest corporations had access to these primary markets, underscoring the importance of these markets. With hundreds of billions of dollars in issuance every month, this primary market is vital for the health and functioning of the global financial system. For me, it is the heart of financial markets. So 2026 so far has been fantastic for this market so far. Top companies like Oracle, Alphabet, and the largest banks and corporations have issued bonds with relative ease to finance building out AI infrastructure or build regulatory capital or finance M&As. So after a record-breaking January, February followed as the second busiest month ever, and March is expected to see, like I said earlier, $230 billion in bond issuance, another record in the making. 2026 as such is going to set a new record of $2 trillion in investment grade rated bond issuance. That's the expectation. Now, will we reach that number? And one of the reasons why people are so confident on why this number could be reached is the strong technicals. Now, when they say technicals, they mean the bid for these bonds, like the demand for these bonds. Investors, like the largest institutional investors in the world, buy these high quality, relatively safe corporate bonds, which are offering now yields of 4 to 6%. Which are higher than what even risk-free US treasuries pay. And default rates in investment grade corporate bond markets are almost non-existent. So buying these bonds has become practically a no-brainer. But here's a catch. When equity markets experience volatility due to concerns about lasting impacts on the global economy because of the Iran conflict, excessive AI spending funded by debt issuance, a slowing economy, falling inflation, and potential interest rate cuts, bond markets can become expensive, and then the supply starts going down. But before all that, to help me unpack all this, I'm joined by Bruce Clark, my colleague and head of rates market coverage at IGM. Bruce, welcome and thank you for doing this with me. So, can you take us through how the year has been in terms of market sentiment on the macro level, and has it changed now?
Thanks, Shank. Thanks for having me. Just to provide some context to the market, we came into the year, the economy was behaving very well early on. Tax changes that were put in effect by the big beautiful bill that was passed last summer, that took effect on January 1, created favorable tax provisions like full expensing for capital expenditures, no tax on tips, overtime, things like that. Economy was doing very well. Employment numbers were good. They had stabilized. They'd rebounded from the fourth quarter. They were doing very well. You had a fourth quarter earnings season that began to unfold in January that was on fire. You had a fifth consecutive quarter of double-digit earnings growth in corporates. Things were going great. To add to that, in February, Treasury yields sort of out of nowhere started to decline as the bond market, the Treasury market, looked ahead and saw some kind of disinflationary factor playing out throughout the course of the year. Now, we wrote at the time, and we still don't know for sure why that is, what the market was seeing. Was it a benign type of disinflation, meaning cheaper energy prices, easier supply chains, things like that? Or was it a less benign event, like a credit event or a slowdown in the economy or something that was less friendly? Regardless.
Sorry, Bruce, what does disinflation mean? Like what do you...
Yeah, disinflation just means lower, the prices are growing at a slower rate. Okay, we're not talking outright deflation where prices actually decline, but just the rate of change slows. Okay, so that will tend to lower bond yields. Whatever the reason, it created an absolute Goldilocks market for corporate credit, which we saw in January and February. The bonds were just coming over the gunnels every day. And then here we go. We have this Iran war that starts, which completely upsets the entire narrative that we had, this disinflationary narrative. You've got a potential oil shock, which has since turned bond yields around and driven them higher. And as we walked in this morning, the Qatari oil minister gave an interview to the FT saying, if we don't get shipping started in the Strait of Hormuz, there's going to be a force majeure by many energy producing countries and oil could go to $150. Well, the market's reacting as you might expect, not very well this morning. Added to the fact that I haven't had a time to look through it, but the non-farm payroll numbers for February came out and were just absolutely dreadful across the board. So again, all of a sudden, the Goldilocks scenario that we had in January and February, is now quite a bit darker. We're not even a week into the month of March, and all of a sudden the script has flipped on so many different things. Decent economic growth, at least stable employment conditions have now had a cloud put over them with this non-farm payroll number. I mean, it was awful. It was a big negative number, 92,000 jobs lost in February. And to add to that, you have this Iran war. Now, I would have to say, and I have been saying, that the economy is on solid enough footing that it could absorb a short-term disruption or short-term shock to the markets. And in all honesty, corporate credit you still had a fairly decent week in credit. There was still decent demand. The equity markets are, they're only a few percentage points off all-time highs. So the financial markets are willing to look past, at this point, this Iran war as a rather short-lived affair. Okay. However, you're at a point now where investors and traders are starting to wonder out loud, you know, could this last longer than we thought?
Right.
You know, because if oil prices stay high, it begins to change behavior, investor behavior, consumer behavior. Gas prices go up for 2 weeks, doesn't change anybody's behavior. But if oil goes to $100 and gas prices are higher for a longer time, it changes behavior, which could change the whole complexion of the market. So, we're sort of at that point right now where in the next week, I think we'll, weekish if oil is still shut in as it is now. Yeah, you'll start having some real out loud worries about the negative impact on the economy and on the corporate credit markets. I mean, it's
Yeah.
it's notably less friendly than it was a week ago.
Well, we could sense that unfriendliness, if I can call this, a little bit in corporate credit. But having covered this market for years, I think the ability for this market to bounce back, the resilience of this market is just extraordinary. So it's like this week, for example, we started with no deals because of the war, right? And there were no deals on Monday. There was just one deal on Tuesday. And then suddenly on Wednesday, we had like 5. And then Thursday was completely mad. It
You
had
had 19
19
deals or something.
Yeah. And they sold 40 tranches of bonds, right? And all of them, the order books, most of them were like 5-6 times on average, like given it's 19 and 40 tranches. When we averaged it out, it came down to like 3 to 4 times, which is still massive, right? They have raised almost $51 billion just this week, right? And 3 or 4 times book. Imagine they had 3 or 4 times that size in orders to buy them. So imagine the amount of money which is looking for a home in these markets, right? So I think in that one metric, you could say that the ability for this market to bounce back is there, right? But we are seeing some strains as well, right? Of course, what is happening is in February, we had 2 weeks when the average estimates set by these syndicates, because they have a lot of insight on what's coming, and they got it wrong, right? They were slightly more optimistic than how much supply came in for 2 weeks in February. This week, although we did like $52 billion, I think it is so short of the 64 billion they were expecting this week. So some say it's because they had this massive deal, which was supposed to come in to fund AI infrastructure build out, and that didn't turn up this week. But today, with this number, the markets are turning around. Like they were rebounding, now they're looking a bit down. I think it's a story of stops and starts in this market, right? Again, which kind of goes into your theory as well, right? I think that there is some inflection point coming in, maybe not like that massive to change the direction of this market, but maybe the other riskier credits could start seeing some changes. Yeah.
Right. Yeah. The financial markets, both the equity, credit and bond markets, have been, the price action this week shows that they're willing and they're eager to look beyond this conflict.
Right.
Okay.
Right.
The markets haven't fallen apart. Volatility remains relatively subdued. There's no huge, freak out going on across the markets. So look, if you turn on the TV on Saturday morning and the U.S. Navy's escorting ships back through the Straits of Hormuz.
Oh, right.
I mean, the whole game changed. The game changes again.
Right.
So look, I have to put aside this payroll number this morning, but I still think that the economy is on fairly solid footing. And I think that that's reflected in the general robustness of the corporate credit market. Now, the timing, for the reasons you describe, issuers could be a little sensitive about timing, and they don't want to jump in front of a train. But I think the broad demand is there, and I think the appetite for locking in yield is still a very attractive proposition across for many investors.
I remember you had like a report earlier in the week when all this war was going on. There is a war premium on treasury yields at this point, right? Like,
Correct.
I
Yep.
think, is that the reason why people are so keen to lock in that yield?
I think so. I mean, I think most investors still look at this as an opportunity,
Right.
to lock in yield. The 10-year treasury right now is trading at 4.15. It was at a month ago, it was at 4.30. So it's still lower than it was a month ago, even though it's off quite a bit off its lows, obviously.
Right.
But I think that there's still a decent appetite to lock in yield and to see this war premium as an opportunity to to get an edge on grabbing a few
But
extra bases.
Bruce, do you think the markets are a bit complacent? You think, are like the credit markets? Do you think they're not, they're always discounting everything, right? Like they're not taking. You could argue that the war is going on, but what war, right? If you look at the volumes and if you look at the way the markets are operating, do you think they're being a bit complacent, or is it like more faith and confidence in the biggest companies in the world, I guess?
I mean, I hate to say that a market is being complacent, because a market comprises thousands of inputs from thousands of people that are smarter than my one brain. So, I'm not going to say that the market is complacent, because there are decisions being made every day. So like I said, I think that correctly, and I still think that this war, even though it doesn't look like it this morning, this thing ends sooner rather than later, and that the corporate credit market will be proven right about their the broad optimism that is still reflected in the market.
And they are, like, you would think that the best institutional fund managers in the world who invest in this market probably have a better outlook on where things are going than most of us. Yeah.
Right.
So it's good to. It's always interesting that the equity markets don't seem to take the lead from the credit markets, which is why I was trying to say in the intro, like when I was started this, to talk about how it is almost hidden in plain sight, this market, right? Like everyone, the best fund managers are dealing with this, but no one wants to take lead from them because they don't really know what's going on in this market, right? Unless you tell them what's going on. So which is quite interesting.
And I remember you and I had a conversation offline where I described when I was back in my trading days.
Right.
We would use the corporate credit market as a cross check against any general bullishness or bearishness that we may feel toward the broader equity market. Okay. Because quite often what would happen, a fairly easy mistake or a trap that people would fall into, is they'd get very bearish on equities for some reason or another. And, they pile in and get short and defensive, and the corporate credit market would not go along with it. So it would signal something completely different. And more often than not, those guys would get caught in a bear trap and get squeezed. And so anyway, so I take my cues from the corporate credit market. And so, a little bit nervous, but still bullish. Yeah, I'm okay with that general outlook right here. Even though today is, even though today it's a fairly lonely, or this morning it's a fairly lonely view.
Right. So. But I think there are these windows of issuance, they would call it, right? And the market, a proper market, keeps going up and down, maybe not as wildly as the stock markets, but at least there has to be a few starts and stops in it, right? Like I think that's part of the way the markets work. But interestingly, this week, I interviewed Richard Wolff from SocGen CIB. He's the head of US debt syndicate, and I interviewed him on Wednesday, right after a no deal Monday and a one deal Tuesday, and all this nervousness about the war. And I asked him whether the $230 billion they're expecting in March will still happen. And he was like, absolutely. And it's it is interesting that they are so sure about. I think the same thing played out in February. Like February had this massive number for the month, and everyone was like 190 billion. And everyone, right up to the last week, no one thought it could be done. Like there won't be this level of issuance because the markets are so nervous and everything. And suddenly that week was completely crazy, right? So I think the syndicate guys are very sure of executing deals, and so what in that there's one thing I would love to say here is because I've covered these markets for such a long time, and what always like surprises me or like I marvel at actually about this market is that this level of extraordinary issuance they do, right? Like so on Thursday when they did 19 deals, 40 tranches of bond, any non-US market, it could be worth months of issuance activity. But for this market, it is only the second busiest day this year, tied with Jan 6th in terms of like number of deals. And in terms of tranches, so 40 tranches, right, in one day, right? And it is only the third busiest this year. So in January, we had like more busier days. And the thing which impresses me the most is that all these deals are announced and priced within hours. So they get announced at around 8:30 in the morning. They get priced and allocated, and the books are allocated by 4 to 5 p.m. So it is almost like a robotic efficiency. And there's not a whole lot of technology there. So it's still phone calls and chat. So there are some busy desks there in the. So I wanted to slip that in because I've always marveled at this thing. But that, if you put together with the fact that this market can operate through any circumstances, the chances of it bouncing back and the resiliency, I think it's going to keep coming back, whatever the situation in the economy. And then you add to it what you were saying earlier is that how corporate credit markets don't overreact to situations, and and companies have been doing well. The economy has been fairly well. There's no real impact on earnings. So what should make people not buy them when they issue the bonds? Maybe the price, right? Like that's the only issue. But otherwise, it seems like we are going. So what do you think we should keep our eye on as we go into this month? What are you expecting to see? Like, what are the things we should look at?
Well, the obvious thing in front of us is how the Iran war unfolds, and what impact that will have on energy prices. As I said earlier, nobody's behavior is going to be changed by a 2-week jump in gas prices.
Right.
However, the flip side of that is if it begins to last longer, oil prices stay elevated for a longer time. To be honest, the U.S. is fairly self-sufficient energy-wise, so the U.S. will be fine, but other regions around the world are not.
Right.
They have to import most of their energy. Asia, Japan, China's a huge customer of Iran.
And my home country, India.
The Europeans are huge customers of Middle Eastern Qatari gas, for example.
Right.
So if things turn ugly, it will get uglier for the rest of the world than for the U.S. But again, you have to watch for that point where you think, oh, geez, this is going to last longer, and we're going to have some downstream effects. It's not just going to be, hey, gas prices went up for a couple of days or a couple of weeks. All of a sudden, you're going to start seeing downstream effects. What's it affect on fertilizer, and then on food, and further down the supply? Just as supply chains were finally normalizing after COVID.
Right.
Okay.
Right.
Now you have another potential disruption to the supply chain. So, we'll obviously be watching for that. Another thing to keep an eye on is the employment situation. Again, that was a shockingly awful number that we got a half an hour ago, and we'll have to see what that's all about. But as we wrote about last week,
right,
Jack Dorsey's block laid off 40% of the company in favor of AI. How that plays out. Does that become a corporate trend where corporate CEOs are afraid that if they don't lay people off, that their boards are going to ask them, hey, what are you doing? How are you adopting AI to make your business more efficient?
Right.
So those two things in particular, are the things that I'll be watching. And so we'll have to see.
Do you have any view on the timing of US interest rate cuts, basically? Like, do you think that's going forward, or it's getting pushed out?
The cuts had been pushed back until now. 2-3 weeks ago, the market had fully discounted the next interest rate cut in June, a full cut in June. Before this number this morning, that had gotten pushed back into the fall.
Right.
Okay, September, October. Now with this number, it's been brought forward a little bit again. But yeah, we're probably talking late summer, early fall for the first full rate cut discounted into the futures market. So yeah, I mean, I again, between with potential inflationary effects of this jump in oil prices, it's going to keep the Fed and just the general uncertainty about the economy created by wars, pandemics, things like that. I mean, the Fed tends to just say, "Oh, hold on a second," and they tend to step back and just let the smoke clear. So, yeah. Anyway, I would not count on any kind of rate cut sooner rather than later. I wouldn't expect that the new Fed chair would ride in and his first thing would be to cut rates. As much as the president might like that, I don't think that that's in the cards.
And there's also talk about the slow recession in the economy and everything. Do you actually see that by the end of this year or next year? Or
to be honest, Shanks, I don't. I mean, I see I see corporate earnings running in double digits. AI spending is very healthy. The consumer seemed to have gotten back on their feet. So I don't see it, but again, so much depends on how this spike in energy plays out. If it's a short-lived affair, I don't see a recession. The longer it goes on, if it does change consumer behavior, of course.
Right. Thank you for all that, Bruce.
Yeah.
And thank you, everyone, that's all we have time for. And thank you for tuning in to Credit Matters, because it absolutely does. And don't forget to subscribe to our podcast on YouTube, Spotify, Apple, or wherever you get your podcasts. Next week, we'll dig into the latest credit events and trends shaping the markets. If you like real-time reports and market data, you can request a free trial of IGM services. The link is in the show notes. Thanks again for listening, and have a great weekend.